Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the financial markets. The Federal Reserve's interest rate hike bets are on the rise. Traders have been boosting their wagers for a quarter-point increase by September, following a spike in oil prices that has revived inflation concerns. The new Fed chair, Kevin Warsh, has taken a hawkish tone, saying the central bank won't tolerate high inflation, which has sent yields higher. According to recent reports, swaps tied to policy meeting dates imply 25 basis points of hikes, up from 23 basis points on Thursday and 8 basis points earlier in the week. This move came during thin trading volumes with U.S. markets closed for a public holiday. The yield on the 10-year Treasury, which impacts the 30-year fixed-rate mortgage, also popped but has since come down. Experts are weighing in on the situation, saying that it wouldn't take much to tip the balance in favor of a hike, given the rhetoric at this week's Fed decision and the multiple references to the Fed missing its inflation target for 5 years running. The recent peace deal between the U.S. and Iran has also led to doubts about the stability of oil prices, which have climbed by around 4% from a 3-month low. As we consider the potential implications of these developments, it's essential to remember that the financial markets are complex and multifaceted. We'll be keeping a close eye on how this story unfolds and what it might mean for your investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of personal finance and risk management today. Our middle segment takes a closer look at retirement planning, particularly for those who have taken a career break. A recent article caught our attention, discussing how individuals can catch up on their retirement savings after time away from work. According to experts, creating a catch-up plan is crucial. This involves allocating a larger portion of your income towards investments over a set period, such as 6 months or a year. It's essential to be a little more aggressive with your savings to make up for lost time. Additionally, using bonuses, performance-linked incentives, or other one-time cash inflows to fill the retirement gap can be an effective strategy. Reviewing your existing portfolio is also vital. Identify investments that may not be delivering adequate returns and consider repositioning them to improve return potential. However, it's crucial to avoid taking excessive risks that don't align with your financial profile. Any additional risk should fit within your risk tolerance, and you should never chase returns blindly or invest in products you don't understand. The key is to maintain discipline and keep increasing investments whenever possible. A career break may delay retirement planning, but it doesn't have to permanently derail financial independence. By focusing on higher savings, making the most of additional income, reviewing existing investments, and maintaining realistic expectations, individuals can rebuild their retirement savings and secure their financial future. It's also important to remember that everyone's financial situation is unique, and there's no one-size-fits-all approach to retirement planning. It's essential to consult with a financial advisor or expert to determine the best course of action for your individual circumstances. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at the current state of European stocks. Recent developments have led to a surge in optimism, with some market strategists boosting their expectations for European equity returns this year. The STOXX 6600 index is on track to outperform its average decline seen in the past 25 years, and data compiled by Bloomberg shows that the index tends to rally more than 1% in July. However, not all investors are convinced about Europe's prospects. Some remain bearish due to the impact of still high energy prices flowing through the economy. A recent survey by Bank of America Corp showed a net 4% of fund managers expect regional stocks to decline over the coming months. Additionally, UBS Group AG strategists note that Europe's rally needs a sustained broadening of capital expenditures away from AI. Despite these concerns, European stocks continue to screen attractively against their US peers, trading at a forward price-to-earnings ratio of 15 times, a 25% discount to the S&P 500. As always, it's essential to approach this market with caution and consider multiple perspectives before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.